This is rather horrifying. A financial crisis like none of us have ever seen before is just around the corner. A contraction of the money supply is telling us that we're going to see a second round of bank failures. I'm going to show you why this is going to happen. It's all related to a money supply contraction, and the banks will be unable to escape this no matter what policymakers do. This from Deutsche Bank, saying that an economic downturn is 100% inevitable. The likelihood of a U.S. recession has sparked intense debate. Considering that the labor market and consumer spending has shown a little bit of resilience, despite interest rate hikes, but Deutsche Bank asserts an absolute certainty of 100% chance of a recession coming. They say consumer spending slowing, with excess savings mostly spent by October, unemployment rate creeping up to just above 4% by year end, and 4.5% in the first 3 months of 2024. Also the fact that geopolitics can affect outlook too. The Russia-Ukraine conflict could intensify, as well as U.S.-China strategic competition. Another risk is a strong El Niño event leading to fresh inflationary pressures from higher food prices. So that's what they say. But one thing we really need to focus on is the money supply.
Okay, looky here. So, now let's dive into why the money supply holds such significant importance in our society. Surprisingly enough, this topic rarely receives attention in mainstream news outlets due to its lack of understanding among the masses. In an economy built upon debt, which is the case we find ourselves in, it is crucial to comprehend that economic expansion occurs as a result of increased debt. However, there exists one vital aspect that needs addressing. Not only must new debts be taken out to repay old ones, but fresh money must also be generated to settle all debts accordingly. As long as money continues to flow within the economy alongside expanding debts, everything seems harmonious. Based on data analysis alone, we can infer that there will never be sufficient funds available to fully eliminate all existing debt burdens, but that isn't necessarily our main objective here anyway. Our primary goal revolves around ensuring there is enough currency circulating within society so individuals have both disposable income and adequate means for paying off their debts, thus facilitating continued economic growth. The challenge arises when we witness periods of contraction suggesting monetary destruction. Money creation occurs through commercial banks lending funds, while its destruction transpires when individuals repay loans solely based on their principal value rather than interest accumulation, namely the principal amount itself. Therefore, we're confronted with instances where monetary contraction becomes apparent. In fact, I believe this is only the third time in history since at least I've been alive, and most of you watching this show probably been alive, that we haven't seen one unless you were actually born back during the Great Depression. This hasn't happened. So when you start to equate this to the fact that we have a huge mountain of debt that has to be serviced because, well, we have a lot of debt. We need enough new money growth just to be able to do that. So as you see a contraction, usually bad things happen, but does it show up in the charts? Well, not so much. Because one thing people will question is, well, it must be the Fed that controls the money supply. And this is a huge myth. The Fed doesn't control the money supply at all. They don't create money. They don't destroy money. They can just raise and lower the federal funds rate as you're seeing here. And there's not really any correlation between the two at all. They can raise and lower their balance sheet, but well, QE does not money print any more than QT is money destruction. But a lot of people point to the money supply and say, well, it has a very strong link to inflation. Well, yeah, it makes sense. And one simple factor is if you lose your job and you go on unemployment, you make less money. So you spend less, inflation comes down because of enough people lose their job and go on unemployment. Their discretionary spending falls. It impacts the broad economy. So it's kind of the same notion here. You're seeing in the money supply, hey, it's contracting. So money's disappearing. There's no way prices can hold up because there's not enough money to maintain demand. You can see when we compare it to the consumer price index, it kind of correlates. When one goes up, the other goes up. When one goes down, the other goes down. But the reason I say kind of, because it looks like one doesn't necessarily always precede the other. But what about financial conditions? Financial conditions are often influenced by the money supply. When it contracts, one would expect a surge in financial pain. Surprisingly, this relationship doesn't hold true in the charts, even during the global financial crisis. When conditions were stressed, the money supply was rising. Therefore, analyzing financial conditions alone doesn't provide much insight. The relationship between the money supply and deposits at commercial banks cannot be overlooked. As money is destroyed or shifted out of banks, the availability of deposits diminishes. This is particularly concerning for small, mid-size, and regional banks that heavily rely on deposits to sustain their operations. With limited access to deposits, these banks face increased stress and the risk of insolvency. The impact of a contracting money supply extends beyond the banking sector. Small businesses, often reliant on bank financing, feel the pinch as well. They echo the sentiment that the situation is bad and is only poised to worsen. With less money available for lending, small businesses face difficulties in securing the capital needed to sustain their operations, expand, or innovate. The ripple effect of this contraction can be felt throughout the economy, stifling growth and hampering job creation. If the money supply continues to contract and banks struggle to attract deposits, the risk of bank failures looms large. Just like a game of Jenga, when the foundation weakens, the tower becomes increasingly unstable. The fragile balance of the banking system can only withstand so much stress before it collapses. Bank failures have far-reaching consequences. They erode public confidence, disrupt financial stability, and can trigger a domino effect throughout the economy. It's crucial for regulators and policymakers to act swiftly to prevent such a scenario from unfolding. And adding some fuel to the fire, Moody's has downgraded several small to mid-sized U.S. banks and may do the same for larger lenders due to funding risks and weaker profitability. The ratings of 10 banks were cut by one notch, while 6 banking giants, including Bank of New York Mellon, U.S. Bancorp, State Street, and Truist Financial, are under review for potential downgrades. Moody's cited growing profitability pressures, a looming recession, and risks in commercial real estate portfolios. The agency also changed its outlook to negative for 11 major lenders. Tightening monetary conditions and higher interest rates have added to the concerns in the banking sector. So this has me thinking, can our banks withstand any impending doom, right? Could your bank withstand a coming economic downturn based on what we've been talking about here? Well, apparently the Fed has been stress testing a lot of major banks to find out just that. This past month witnessed a significant event in the financial world: the Federal Reserve Bank's rigorous evaluation of 23 major commercial banks. With assets exceeding $100 billion, these banks play a pivotal role in the global economy, and there's a good chance your money resides in one of them. Usually, such tests don't garner public interest. However, given the recent failures of several regional banks, all eyes were on these tests, making them a hot topic of discussion. The focus of these tests is what's termed minimum capital requirements. In simpler terms, it's the reserve these banks must maintain to weather unforeseen financial storms. So how did they fare? Quite well, apparently. Even when the scenario envisioned a hefty loss of $541 billion, every single bank emerged resilient. But that raises a few pressing questions. For instance, while $540 billion sounds colossal, and it is, how does it measure up in a broader context? Moreover, given that stress tests in the past weren't always able to predict significant bank failures, their credibility is under scrutiny. After all, if these tests couldn't prevent the collapse of regional banks, how foolproof are they? As a result, the banking system's integrity remains a point of contention for many, despite the positive outcomes of these tests. In Wednesday's report, the Fed said that recent events have highlighted the need for humility when assessing large bank resilience. Stress tests should continue to evolve over time to reflect an appropriately wide range of risks in today's complex and interconnected financial system, the report says. I delved deep into the Fed's recent report on this topic to help you and me feel more assured about the sanctity of our hard-earned money. Before delving into the specifics, let's establish the backdrop. Thanks to inflation's upward climb, the Fed found it necessary to hike interest rates, making borrowing more costly. In anticipation, several smaller banks invested in treasury bonds, a routine practice. However, this strategy backfired when rising interest rates depreciated bond values, which in turn diminished the value of deposits. A resultant wave of panic ensued as people scrambled to withdraw their funds, compelling these banks to offload assets at a loss. This sequence of events crippled many of them, financially speaking. To avoid a repeat of such incidents, the Fed is determined to keep banks in check with these stress tests, designed to measure the elasticity of their financial backbone. These tests are categorized based on the size of the banks, from Type 1 to Type 4. The larger the bank, the more frequent their tests, with some undergoing the process annually. Among the banking giants subjected to the most recent evaluation were household names like Bank of America, JP Morgan, Barclays, and Wells Fargo. Rather than employing layman-friendly terms, the financial sector dubs the reserve requirements as CET1 or Common Equity Tier 1. Think of this as a bank safety net, buoyed by shareholders' contributions. All 23 U.S. banks that participated in a new Federal Reserve stress test would be able to withstand a severe global recession, demonstrating the strength of the biggest financial institutions at a time when the banking industry still is on uncertain ground. The Fed, the apex financial institution lays down guidelines for other banks, prescribing how much they must set aside for contingencies. After the rigorous evaluation, banks are graded on their financial health, with designations ranging from well-capitalized to critically undercapitalized. Think of it as the academic grading system A, B, C, D, and F. Obviously, A is what they aim for, while anything below C attracts punitive measures, including restrictions on lending capacities and dividend disbursements. To score an AA, a systemically significant bank must retain at least 10% of its total assets. Applying this to the recent tests, banks with assets of at least $100 billion should have kept a minimum of $10 billion in reserves. The findings revealed that on average, these banks had a safety net of 12.4% before the test, which dipped to 10.1% post-test. At first glance, these figures are reassuring. After all, even the minimum acceptable reserve, corresponding to a grade of D, stands at 4.5%. However, there's a twist. This average figure doesn't reflect individual performances. It's akin to declaring an entire classroom as A-graded. While the class might have an average of A, individual grades could range from A to C. A deeper analysis revealed that while none of the banks flunked, not all achieved stellar grades. Citizens Bank, for instance, barely scraped through with a 6.4% reserve, while Charles Schwab emerged as the valedictorian with a robust 22.8% reserve. One must wonder, what cataclysmic events would precipitate a loss of $540 billion? The Fed provided some clarity, defining their worst-case scenario, a severe global recession causing long-lasting declines in both residential and commercial real estate prices. They also envisioned a dramatic spike in unemployment rates, a significant dip in the GDP, a nearly halved stock market, and extreme volatility surpassing even pandemic levels. Results released by the Fed Wednesday show that these banks would have enough capital on hand to absorb losses and continue lending even if unemployment were to hit 10% and the stock market were to plunge 45%. Their projected losses would amount to $541 billion under that hypothetical scenario. The biggest of the group, JP Morgan Chase, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, and Morgan Stanley all would have capital buffers well in excess of the Fed's 4.5% minimum requirement under this extreme scenario. Such a grim scenario is tough to digest, but it is essential to be prepared for the worst while hoping for the best. But how credible are these stress tests? They are rooted in complex algorithms and intricate calculations, but they're as reliable as the data they're based on. The failure of regional banks earlier in the year showcases the pitfalls of relying solely on these tests and underscores the importance of broadening their scope. Despite these concerns, for now it seems our money remains relatively secure, at least with major commercial banks. The banking universe is intricate, and understanding its intricacies is a Herculean task. But knowing more about it certainly makes us feel more in control and hopefully a bit more assured about the safety of our investments. Let me know your thoughts in the comments. And if you like content like this, please hit that subscribe button. Also take a look at some of my other videos where I dive deep into other info like this.